Hi there. My name's Lisa Reisman. We're just going to take another minute and let everybody in, and then warn you all that we're running an experiment here. So you will be our first guinea pigs of a dual live event, which I'll explain in a moment. We'll give everybody another 30 seconds or so. Right. Okay, good morning or good afternoon, depending on where you're sitting. My name's Lisa Reisman. I'm CEO of MetalMiner. I'm going to be speaking with my colleague, Don Hauser, who's the Vice President of Business Solutions. So we're running a giant experiment here, and I just wanted to mention that right off the bat. And the experiment is that we are dual live streaming. So we are on LinkedIn Live. This is our first LinkedIn Live event, and we are also on Zoom. There's about a 30-second delay, so we'll keep that in mind. But what I want y'all to do is any questions you have, this is a live event, throw questions into the Q&A or into the chat feature on your LinkedIn. The chat's going to be moderated, and we'll try to answer everything that we can on the fly. So feel free to just use that feature. So for those of you who know us, I'm going to let you know that today's discussion is going to be a lot less on just the specific forecast and more about some of the strategies and tactics and things we've seen in the marketplace going into 2023 contracting season. So with that, let me walk you through the agenda. So we are going to, as I said, kind of cover what is the problem that we seek to solve. We'll just kind of review that. We will go over the standard things that we look at from a macroeconomic perspective that kind of sets the tone for the type of market that we're walking into for 2023. I'm going to do a little procurement 101, and we'll take a look at some of the tips of the trade from a more macro perspective. Hopefully this will help you with your communication with your C-suite. That's the intention behind that. Then we'll get into some of the specifics. So we'll cover aluminum, stainless steel, carbon steel, and also I noticed some of you are in the industry where you might be interested in grain-oriented electrical steel. So I even have a couple of slides for you on that topic. And what we'll do is kind of walk through what we're seeing, very high level, and then share with you some of the case studies of things that we're seeing, and then hopefully leave you with some takeaways. Okay, so setting the right strategy, right? This is the big issue, right? We've had a couple of years of a lot of different things that have gone on where we have not been in the driver's seat. We've been basically at the whim of the suppliers. It's been a supplier market for sure. The second half of 2020, 2021, most of 2022. And now we find ourselves, thankfully, in a different seat. We're now sitting in our own, we're in the buyer's seat, and we have the buying power this year. And I think that is very empowering. All of that being said, we still have some of the same things that we've seen. We still have a lot of volatility. And in fact, I would argue if we look at the VIX index, we even have more volatility right now than we did a year ago. So even though prices have come off and we're more in the driver's seat, there's still a lot of volatility in the market. And I don't need to tell any of you that we have a lot of economic uncertainty. You guys have been living and breathing economic uncertainty for 2.5 years now. So there's no point in really discussing that. So what's the big problem? The big problem that we want to help you solve is uncertainty makes your life more challenging, frankly. It makes contract negotiations a little tougher because you don't know exactly the market that we're facing. And we have a lot of mixed signals and different concerns. We have on the one hand, some concerns about availability still with certain parts. And then on the other, there's kind of a glut or too much inventory, and people have too much inventory on hand for other things. So all of that goes into the strategy, and we hope that, we're going to address that head on in today's discussion. So this is just my personal pet peeve. I know that when markets are working in the buyer's favor, you might be getting more pressure from your suppliers to sign on early and often, as we like to say. And everyone hates to be pressured. And that being said, there are a couple of markets where you probably are going to want to be looking at locking in the month of November, because you might be at the low, and I'll talk about that when we get there. But at the end of the day, this is sort of that pet peeve of, we don't want to be pressured into making a decision or to be rushed into making a decision, particularly when we're seeing markets fall. And that's certainly the case with carbon steel right now. So you might be or you are hearing from your suppliers, to probably sign on early, and Don's going to address that when we get there. So what's a major frustration, as I've indicated, it's kind of, the mixed market signals. So we look at things from a macroeconomic perspective to give you sort of an overview of the long-term trends that we're seeing, because that's what should guide your strategy, your contract negotiations for 2023. At the same time, looking at the short-term trends will allow you to time the market more effectively right now in this fourth quarter. Okay. So again, now I'm going to get into the macroeconomic outlook. So for those of you that do know us, you know that we look at a few macroeconomic indicators, the main one being this CRB commodity index, which is the line in purple, the jaggedness in purple. And just because I didn't want to bore you to death with slides, we've overlaid the US dollar, which is the green line. Why do we look at both of these two? Typically there is I'll give you the exact number. It's a negative 0.93 correlation, meaning when commodities are high, the dollar tends to trade lower and vice versa. Yes, there have been some times where they both have moved in the same direction. I mean, you can see that, you can see that here, but a lot of this reverse thing is what we typically see. And very recently, and we know the dollar was super high, it's come off a little bit, and we've seen a little bit more life in commodity prices, if you will. And we'll get to what that macroeconomic indicator means for everybody. What's driving that CRB up? So we are in a long-term, what we would call uptrend, but we're in now a sideways short-term trend. So in the CRB index, which is mostly oil, which I'm going to touch on in a second, which is about a third, agriculture prices are the other big factor, and there's been sort of a mixed bag on that. So we saw some increases in orange juice and live cattle prices, for example, but they were offset by declines in coffee and cotton. So that kind of weighed on the index. All remaining categories of the index, including energy, which I know is near and dear to many of you, base and precious metal prices have traded up. Some of the base metal prices have traded more sideways. And with the exception of natural gas prices, of course, which also fell about 6.5% last month. So all in all, while it remains in a macro uptrend, the US dollar index traded sideways this past month. We're watching the dollar very closely because it's going to give us a big clue and a big signal as to where markets could go from here. So again, a falling dollar typically indicates stronger commodity prices, and commodity prices have a very tight correlation with industrial metal prices. Moving on to oil quickly. I can see that there we go. We'll give that a minute. So we can see, there'd been that run up in oil prices, and now I just checked this morning, oil's trading at about $89 a barrel. I would say the consensus view is that oil prices will likely increase. And again, this would impact commodities as well. Obviously, there's also a close correlation with aluminum. So oil is something that we keep a close eye on. So from a macroeconomic perspective, we're looking at the CRB index, we're looking at the US dollar, we're looking at oil prices, and we're looking at the DB base metal funds. So these are the base metals. So following mixed price direction last month, aluminum, copper, and nickel prices have all traded sideways. But again, we're in more of a macro downtrend for base metals, which means we could expect a more bearish market, but there's still going to be volatility inside of that market. Moving on to China, we like to track this iShares China Large Cap ETF. It's the FXI index. I like it because it gives you a greater perspective. It moves, it's got a wider band of movement than, say, GDP data or PMI data from China. So, you know, we are in a pretty serious downtrend in China, and this has a lot of impact on two things. One, on metal demand. China's still the 800-pound gorilla from a commodity demand perspective. So demand is off. It also means supply is constrained for certain things, particularly because of the COVID lockdowns. China's still implementing COVID lockdowns. We do see those lockdowns. We thought that they would be, you know, alleviated after the new Congress and the new you know, Xi taking power again for another 5 years. We thought maybe zero COVID would be something that would change, but that doesn't look like they're going to change that policy. And we think that's partly due to trying to tap inflation in China and keep inflation under control. Okay, so with that, I'm going to move into now, I'm going to go back and review something. For those of you that have been in procurement for a long time, you might be very familiar with it. Our famous 2x2 acrylic matrix. This is sort of the sourcing 101. And I want to caveat this slide by saying, I want to talk about this a little bit because I think this will help you with some of your discussions with executive level team members who might be coming back to you saying, hey, I heard steel prices are dropping pretty rapidly now. I'm sure we're getting big double-digit cost reductions, which might be true that you should be getting, but not all metals categories fall into each of those buckets. So just kind of going around the matrix here, I'll talk about bottleneck items. When I think about bottleneck items, I think about the energy crisis in Europe, and particularly a lot of copper parts and materials are coming from, and those are pretty high-end precision parts. In some cases, a lot of companies are sourcing those. They're sole sourced parts. Those are the bottleneck items, right? Only certain suppliers in the world can do that. The category strategy here for 2023 is to be working on identifying alternative supply arrangements wherever possible, have a plan for backup, be working and partnering and remaining in close communication. In fact, I just heard yesterday that one of the suppliers, there was a big cyber attack. They're down for a week. No email communication, no order taking, no production at any of their global sites. That's Arubis for any of you that are buying copper parts from them. So that strategy looks a lot different than, say, you know, what you would do in the lower left quadrant. And that strategy, the lower left, I think of your MRO items there, right? It's about automation, working with your key distributors like a Grainger or Fastenal. And some of you have that responsibility. And that obviously is a different strategy. You're focusing maybe more on having different suppliers, but really it's more about automation. Next, moving lower right into the leverage items bucket. I think we argued this includes many of the metal categories this year, particularly carbon steel. I could see in this bucket. You definitely want to be bidding this out and making sure that your suppliers, that you're paying, quote, the market price, that you're doing a more competitive process. I think, Don, if you've got any comments, we'll have you add them in your section here on that. But that's kind of where I would think about steel. And then to the upper right, you know, thinking about the strategic items, we've fielded some calls recently, and I'm going to walk through a case study example in aluminum about a category that really is in this bucket where you're looking to form strong partnerships. Maybe there's a small supply market for those materials. I think about exhaust grades for stainless steel. There's not that many suppliers of that material. So here your strategy is going to look a little different. Maybe you're looking at, you know, maybe we bring some of this capability in-house. Maybe we look to vertically integrate. So But the point I want to make here is when you're talking with your C-suite executives or they're looking for your strategy, make sure that you've kind of bucketed out your different categories and explain to them why you have a very different strategy based on the metal that you're sourcing. Okay, I'm going to dive into, let's get into it a little bit. Again, normally when we do these presentations and workshops, we get a little more detail into like what's driving the market and, where do we think the market's going to go and what are our support and resistance bands. We do this thing where we basically project out for the next 30 days where we think a metal price is headed. And then we give an industrial buying strategy. What should you do based on that price movement? But what I want you to take away from here is essentially the slope of the two lines. So the top being obviously the ingot price. We're in a very different place than, you're much lower than where we were at the end of last year. And you want to make sure that you are capturing some of that, that cost down with your suppliers. At the same time, and this is a little bit more dynamic, we look at the Midwest premium as a good indicator of regional demand, if you will. And what I mean by that is North American demand. And that too has been in a downtrend to some extent for most of this year. However, if you look right at the end here, there's a little kind of tick up, which is just important to note. I call it noise for the moment, but we're obviously watching that. So the overall arching kind of takeaway here, and when you think about it, you should be communicating these downs with your supplier in your negotiations. So now I'm just going to kind of walk through a little example case study that we worked on this week. A packaging client, and they're purchasing a laminated product, so a foam on one side and aluminum foil on the other side. And they had approached us and said, we had gone to our supplier, we asked for an 8% across the board reduction. They gave us the reduction right away. And now we're wondering, maybe we gave a little too much. Maybe there's a little bit more there. How do we think about this? So, what we did was we basically, just shared similar, more detailed information in terms of what I had just shown on the previous slide, but looking at where are those numbers coming down? And then they looked at their total cost of ownership, breaking out the cost of the laminate, the foam, the value add, the freight, et cetera, in order to reprice that category. And so their cost model basically said, we believe the number should have been 15% based on that, the aluminum percentage of total cost. So they've gone back. We don't know the result, but that's what they've asked for 15% and didn't want to leave this, 7% on the table. Now, whether they get the 15% or not, we don't know the answer to that, but they're probably going to be able to claw back more than just the 8%. And that's the point of having this detailed cost data going into next year. I'm going to move on and share kind of a different tool. This is a snapshot from the MetalMiner Insights should cost models. The thing I want to point your attention to that I think is really important is to have a surcharge forecast. I'm not aware of anybody else that has one of those. It's important in the short term when you're able to quote time the buy. So let me share just some data. Unfortunately, my colleague, Katie Benchina Olson, who was going to join us this morning, has a sick daughter she had to take to the doctor. So I'm filling in for her, but I'll share some of the notes that she has, recently put in our monthly outlook, which I think would be important for everybody to know. First thing is service centers are continuing to shed inventory and are appearing more eager to do deals, essentially. We think the low point for 304, the spot price, may come this month. The surcharge dropped 11 cents a pound, due mainly to price declines in ferrochrome as well as ferrosilicon prices. And buyers are going to know very shortly in the mid-December timeframe whether the November surcharge will continue falling lower in December. And again, this is the kind of information we publish, which would help a buying organization decide if they're going to lock in for end of November or et cetera. So that's just a quick little way to kind of time the market. Flat rolled stainless contract pricing for 2023 has different price progressions depending on when the contract was last negotiated. So if you the end user, are working off of pricing that was established in early 2022, early in the year, your base prices could appear higher in 2023, depending on your alloy width and thickness combination. Particularly if you're in the automotive ferritics, that's the 409, 441s, 439s, et cetera, and under 1-year contracts. For 2022, you're going to see some increases between 10 and 18 cents a pound. Again, that's 10 to 18 cents a pound. For those of you that took increases during the second half of 2022, your prices should look and remain mostly flat. You shouldn't really be seeing base price increases. So if you are, we'd encourage you to push back a little bit. But again, that also could depend on your alloy with gauge combination. And again, some of these are a little more blanket statements, and obviously your situation or circumstance might be a little bit different. Actually, I didn't, it looks like I missed a slide. I put a slide, I wanted to kind of quick do a case study, and I don't think I had that in there. But on this one, the same thing happened from a case study perspective. We were working with a manufacturer that was asked to use a CPI price index, which of course had increased by 7%. The supplier approached the customer, our customer, and said, we are going to raise your base prices by 7% because we're using this CPI index. And, we consulted with them and gave them essentially some ammunition to say, no, you should not be using a CPI price index. That's the wrong index to correlate with stainless. We identified an alternative index. We published those indexes as well, but there's others besides ours that can be used, and gave more favorable pricing to the buying organization. Okay, so these are my grain-oriented electrical steel slides. I've only got 2 of them. Here we were contacted by a prospect that historically has told us, prospects in the oil and gas industry. Actually, I'll just kind of show, this kind of just gives you a sense of what's gone on with the market over the last couple of years. We have 10 years of price history for GOES, maybe even more. So we had a prospect call us to say, hey, we typically have always sourced this category with basically a sole supplier situation where we contract with one single supplier at one set price. That price is locked and loaded for the year. But now the supplier has told us that they want to work on more of an index-based mechanism where maybe the price will fluctuate on a quarterly basis. So our client said, or our prospect rather, had said to us, what's out there? We need a third-party neutral index. There's no way we're going to use our supplier's index for our contracts. So again, looking for third-party alternative indexes, neutral, where there's no relationship with supplier, customer, et cetera, or kind of just third-party neutral, was key in terms of implementing that. And I just wanted to share some of the reason why there has been, this ask for it to be on index. There's been a tremendous amount of price volatility. Of course, this is the same for every category that we've seen. And I'm going to skip the next slide because I actually, unfortunately, popped these in the wrong order last minute. This was our stainless steel example. But with that, Don, I'm going to move over to you, and we kind of touch on carbon steel. Again, just want to pause for a moment. Feel free to throw in any questions in the chat or the Q&A feature.
All right, thanks, Lisa. So carbon steel is kind of seeing that downward trend like a lot of the other metals. And like the other metals, if you are paying attention to the trend, there's different mechanisms, there's different strategies on how you should buy. That's why it's really important to always continuously look at the trends and update your strategies. What was a great strategy last year would be an awful strategy this year. So as is what we're showing here is the steel market for hot rolled coil in some different regions. You have the US, Korea, China, and Europe, kind of the major players that a lot of people use. You can see the US market is the huge spike up. So in that market, you could look at imports, you could look at trying to fix your pricing, you could look at scrap indexes, you could look at all those things. And now on the way down, all of those things that I just said would be not such a great idea. Now the US price is below some of the other countries. Imports are really drying up. So your import strategy, if that was a piece of your strategy before, you have to really kind of look at that. Do you want to be importing steel from Korea or Europe at this point? Probably not. The Chinese market is pretty much always going to be lower than the US, but there's really not a whole lot of hot rolled coil coming in from China because of all the additional duties. So the point that I'm really trying to make here is twofold. You need to really examine your strategies based off what the current trend is doing. And then back to that 2x2 that Lisa showed earlier. For the most part, carbon steel is a little less of an engineered product, a little more available. So it should primarily be in the leveraged bucket that you can go and really get cost reductions for. If you haven't gotten them yet, you should get them now. You should base your strategies going forward on how you can continue those. But there may be certain grades of steel. Maybe you've designed it, or there's a special application for it, and it has to come from a specific supplier, or you're importing it from a specific country. I can think of specific products from Europe and some of those mills that are a little different chemistries and a little different design that go into specific applications. You still need to kind of examine those and make sure that you're not lumping them in with everything else that's in the big piece of your buy that you can go really hammer on for cost reduction, because some of that may still be supplied constraint. You have to kind of play nice with those suppliers to make sure that you get the material if it is a little more specialized. Okay, can you go to the next slide, please? I gave you kind of the broad overview of some of the big things that you can look at for strategy. This is something that I like to show people kind of on a regular basis that's a little more specific. So you're looking at the difference between hot rolled coil and plate. There's a pretty good range that you can usually use either one of those products. You guys hear me talk about this a lot. Between 1/4 and 3/4 of an inch, you can usually use discrete plate or hot rolled coil. They make both of those products in those gauges. They do kind of perform different. They might bend or burn a little bit different. But for the most part, you can kind of flip between one or the other. So this is something that could be a strategy for you. If you've qualified these parts both in plate and coil, then you can kind of flip them from one to the other when it makes sense. Coil has processing costs, your service center costs, kind of all that on top of just the coil cost. So anytime that plate is relatively close, or in last year's case, most of the year it was actually cheaper, it's super cost advantage to go that way. And now you're seeing the exact opposite. There's somewhere around $1,000 difference a ton between a coil and a plate product. And if you have the ability to flip that over, saving $1,000 a ton is a massive savings. You kind of have to have some of that stuff in place. I talked to a customer the other day that is currently kicking off a project to see if they can flip some plate product to coil. It's one of those things that changes a lot. This specific example changes a lot. So if you have material in that 1/4 to 3/4 inch range, you might want to trial some stuff, qualify it, see how it performs. Can you really just flip it from one to other? It's a good chance to really save some money. Those are the type of specific projects that you really need to kind of watch the markets and really dig into that. You can really have some big cost reductions that way. Next slide, please. So these are kind of the overall strategies. They apply, some of them are kind of metal specific, some of them are the market in general. Some of them might work for you depending on what you buy, what you don't buy, or what your overall company strategy is. Some companies are a lot more risk tolerant. Some companies want no risk. So you have to kind of mix and match and reevaluate both the strategies and where the market is going. So in general, if prices have recently fell and at a bottom, you might want to hold off on long-term purchases. This sort of sounds counterintuitive. So it seems like if it's at the bottom, you might want to take a long-term, but you really have to be careful that it's not going to continue to fall. And that's kind of where we're going with this. When Lisa talked about we basically don't try to time everything at the bottom. This is exactly what I'm talking about in this point. If it falls off, a lot of people will instinctively say, wow, it's fallen off, 40%, I should take a long-term buy on this now. And is what we really try to tell people is you really need to see a reversal of that before you really start to go long on that. Just because something's down 40% doesn't mean it can't be down another 30% from there. It definitely can do that. So as things come down, you really have to kind of watch and see where is it going from there. A lot of times, especially in this market, it looks like things are continuing to fall. Don't get trapped in that. It's down 25%. I should really go long on this now. Continue to purchase for short term if there's mild volatility. If you're in a sideways market, which some of these metals have kind of moved more into a sideways market, then you can kind of just purchase short term. If it's going sideways and there's mild volatility, you can't really be wrong too much one way or another. That's kind of the easiest market to buy in. If there's mild volatility and it's going sideways, you're just kind of good. You can follow along. The problem is there isn't a whole lot of those markets, and when they do happen, they don't tend to stick around too long. In the current situation, most of these metals are getting very volatile and staying volatile. Lock in longer time periods once prices hit the higher. Now, this is kind of the inverse of the first point that I talked about. And we're talking about when period hits a higher resistance level, not necessarily the price gets there, but is what tends to happen is prices will float around in the bands. And if it breaks out of that band, then that's when you might want to look at it locking in a longer time. Like I said, it's kind of the inverse of the first point that I talked about. Don't try to time the market for the lowest of the lows. This is a big thing that I tell everybody. Try to stay off of the peaks and the valleys. A lot of people will really try to time that bottom and get the best price that you can. Sometimes that works and you save a ton of money, and sometimes it goes way upside down and you're looking for a new job. If you're in it for that kind of risk tolerance, then good for you, I guess. I don't think most people and most companies are. Trying to time bottoms is a terrible way to manage your spend long term. So really be careful of that. Time your short-term buys when prices are falling close to support. So there is times when you can pull stuff in and make a short-term buy. You can kind of see what's going on. Those opportunities are out there if you're really kind of watching the market, if you're getting the insights and the information that you need to do that, and you have the flexibility within your buy to do it. So those are always out there if you've kind of done your homework and you're prepared on what can you do, what materials can you make these kind of short-term tactical buys and save some money, and you have some processes set up in order to do that. It's always a good practice to take advantage of those if you can. And then a lock-in forward buys an early side of the trend reversal. Again, talking about bouncing off the bottom. For us, we tell people, hey, it's reversed. It's coming back up. We don't tell you, hey, it's the bottom, here's where it is. But you kind of have to be ready to take advantage of that information within your strategies. If you have something locked in and you're locked and loaded and you have to write it for a year, then you can't take advantage of some of this. Again, this is why I talk about a portfolio strategy. I tend to advise people, and when I bought metal myself, I liked a portfolio strategy. So there was some flexibility to take advantage of some of this. Not that I wanted to have it all open and expose all of the risk, but if you have the availability to take advantage of some of the trend reversals, you kind of got to watch it and be able to move, to be nimble, to adjust your strategies or take advantage of some of the opportunities that you built within your portfolio strategies.
Don, before we move on, if you don't mind, if I have a couple of questions that if I could just interject, if you don't mind, and anybody else have questions, throw them in the chat or the Q&A. I know, Don, like in the steel industry, we often change kind of like what kind of contracting mechanism should we implement or use? Should we use scrap cap collars? Should we use another third-party index? What's the strategy for next year? How would you think about it?
Sure. All of those that you mentioned work kind of better in a rising market. I think you're starting to see more of a declining market. Well, not starting, you've seen a declining market, and it looks like that's going to continue. So I think kind of the best strategy going into next year is wait it out a little bit longer. The mills have been kind of pushing for contracts, negotiating them, signing them a little bit early this year. Kind of red flag for me typically. You're getting kind of pushed into something, and as the market gets softer and softer, I'm seeing better and better contracts. I think going forward into next year, the prices for contracts on next year in carbon steel anyway are getting pretty low, kind of almost back to historical norm levels. So there's a couple different things to do with that. One, you might want to lock in some of that. So if you look at the cost of goods on your end, and you match that up with where you can actually buy steel and fix it, if that allows a good margin for you, you might want to lock some of that up at some prices that I think are getting pretty reasonable for fixed contracts next year. And then the other thing is discounts. So if you're a large enough buyer or a good enough customer that you're able to negotiate discounts, there's always this game of a % discount off of an index or a straight dollar per ton discount off of an index. Is what typically happens is as the price rises, the mills will try to push you into a dollar discount because it's to their advantage. And then as it falls, as it comes back down, then they want to flip you back to a % discount. It's probably in your favor to do the opposite. On the way up, you want to try to negotiate more of a % discount because you're getting more as the market comes up. Falling, obviously the inverse is true. If you can lock in X dollars per ton discount as the market continues to slide out, your % discount would actually go up if you have a fixed number. Those are a couple of the things that I would probably look at to negotiate in for next year. And then there's always the extras too, is there's more and more competitions and mills want to do, they're a little hungrier for business. You can always go after your high volume grade extras. Maybe half of your buy is a grade 50 material, for instance. Maybe you can get a dime or a quarter off of that grade extra. Kind of really bolsters that for half of your buy if that's what you're doing. So those are kind of the areas that I would go after.
Don, we got a question on the aluminum side, so I was going to answer that too. It's pretty similar. What kind of third-party index is there for aluminum? And I think, to be candid, a lot of aluminum contracts that we see are typically using, one of our competitors, average 30-day LME trailing price. as quote the index. I think the game with aluminum is to really understand what the conversion premiums are and to lock those. What we see oftentimes is people have some fluctuation for the ingot and the Midwest premium, but then they're also getting fluctuation in the conversion premium. So as prices go up, like the whole cost goes up. And the strategy there is really to make sure that you lock and load and contractually lock that conversion premium. And you're still going to just float your Midwest premium and your, your ingot to whatever index. It's always off the LME, and then the Midwest premium is the CME, the COMEX price. And then you have an opportunity to hedge that if that makes sense for you. So a lot of organizations, I know just looking at the list of attendees, a lot of folks are hedging organizations. So then you could hedge that. Unfortunately, there's no other kind of third-party index, anything will kind of do for that, if you will.
I think one step back on that is make sure you're looking at all of those. There's several customers out there that are only looking at, here's your number. So you have to look at the ingot price, you have to look at the Midwest premium, you have to look at the conversion cost. If you don't know those three, then obviously you can't lock anything, you can't push one around or the other around. You're stuck with this kind of black box price that really kind of deteriorates your leverage.
Agreed. I'm going to flip you to the summary slide. And again, just want to encourage anyone, we've got 4 minutes left. So if anybody wants to post a question, feel free. Don, you want to kind of run?
Sure. Yep. So know your underlying price trend, super important, especially if you have more flexibility in your strategies. So you have to know your trends in order to utilize that flexibility that you've built into your buying strategy going forward. There's that piece. And if you haven't built that flexibility in, every year you should be looking at your strategy and what you're doing for the coming 6 months or 12 months really is based on what is the pricing trends. You have to know the pricing trends so that you can set up the best strategies, whether it's kind of locked in or whether you're building in that flexibility. You have to evaluate those every 6 to 12 months in order to look at that, because these trends move so fast. And if you're on the wrong side of them with your strategies, you can really be leaving a lot of money on the table. Break out the cost structure for leverage. We really just kind of talked about that on aluminum. It really goes across a broader range of materials than just aluminum. If you're just looking at the base metal, in some of these metals, you're not looking at 60% of the cost if you're only looking at the base. It's different from metal to metal and what those percentages are. You really need to get that cost breakdown so that you can fix the pieces that should be fixed. The last thing you want is a part, and they say the steel market's up 10%, so your part's going up 10%. Well, that's trash. Their cost isn't actually going up 10%. Some of it is going up 10%, but you shouldn't see a 10% increase. If you don't have that breakdown, it's hard to really push back on the suppliers. I found that if you just have that information, that conversation is a lot different. As soon as you're like, well, here's what I see, tell me where I'm wrong, you can have a real conversation about it. Use a surcharge predictor, some kind of forecast on that, like we provide, that will help you with some strategic buys. And actually, I'm sorry, more of the tactical buys of pulling stuff in, pushing stuff out from month to month, that going on. Pursue product substitutions. I talked a little bit about that with the hot roll coil and the plate. There's all kinds of that going on. Aluminum to stainless, steel to aluminum. There's all kinds of things like that. You have to kind of watch all these markets and see, is there an opportunity to substitute stuff in? Portfolio strategy, I think I talked about that at length. Every time I do one of these, I talk about the portfolio strategy. And de-risk the global chain. If you're buying stuff from some other country, albeit Europe or Asia, wherever it is, if you don't really need to, it might be cost advantage to pull that back in and kind of de-risk some of that chain at this point. these are kind of some of the metals that we cover. There's a lot of things that we cover. There's some new stuff in there. You might see some of the lithium and manganese. We've added some battery metals. Lisa talked a little bit about the GOES product that we brought in. We've also brought in a lot of the battery metals, which might be interesting to some folks. Created some battery indexes, as well as the individual components, the metals that go into making batteries, and a whole host of other things. I just kind of want to give you a snapshot there. Some of the other things that we offer, some newsletters. Obviously, you can kind of contact us anytime and look at some of the insights, the platform, some of those things, articles, contact page.
Yeah.
Feel free to contact us anytime. The website's there. You can reach out to me personally. Just shoot me an email. There's always a phone number there as well. Easy to get a hold of, and we'll get back with you any questions that you might have.
Great. Thank you. I want to thank everybody. We've come up on our 45 minutes. Appreciate this. Hopefully this worked out well for everybody on both sides of our trial here. So thanks and have a great day.